Most investors operate under a comfortable assumption. They know accounting profit can be manipulated like a spreadsheet fiction, but free cash flow? That feels tangible, like liquid cash solidifying into real value, money a company can actually use. The price to free cash flow ratio calculates what you pay for each unit of cash produced. Breaking down the bottom half, free cash flow is operating cash generated daily, minus capital expenditure, the money spent to maintain existing assets. The standard theory suggests that a low ratio indicates a hidden bargain. It implies you are paying a discounted price for a powerful cash machine. But treating this isolated equation as absolute proof of a company's worth is the starting point for one of the most dangerous, value-destroying mistakes an investor can make. Look at Rivertech and SteelBuild. Both sit at an attractive multiple of 10. But Rivertech's cash is driven by unpaid receivables, while SteelBuild depleted inventory for a temporary cash pile. Next year, Rivertech collects and SteelBuild restocks. Both cash profiles swing violently. Because short-term working capital decisions dictate these sudden swings, treating a low multiple as a guarantee of stable cash is an illusion. Let's consider a third competitor, Inframax. They operate in heavy infrastructure, yet they also trade at that identical multiple of 10. This chart tracks their financials. Notice how their operating cash flow remains high, while their capital expenditure intentionally drops towards zero. This widening gap creates a massive, paper-only cash flow. But infrastructure requires constant upkeep. To achieve those accounting numbers, Inframax is delaying essential maintenance and halting expansion. Their physical assets are visibly degrading. The long-term mathematical consequence is an unavoidable surge in future spending to repair those neglected pipelines. That required spending will eventually wipe out future cash flow. When a business starves its own future to boost current metrics, today's cheap valuation is a ticking time bomb. Then we have CloudNova. They trade at a multiple of 30. To a beginner looking strictly for a bargain, this immediately looks too expensive to touch. But CloudNova is a software company. They generate stable margins with almost no requirement to constantly rebuild physical assets. This chart compares their trajectories. While the three cheap companies struggle with volatile or stagnant growth, CloudNova's cash flow compounds smoothly upward at 25% a year. Every dollar CloudNova generates is truly free. It doesn't have to be funneled back into rust prevention or inventory. It can be used for new expansion or returned to shareholders. Comparing raw multiples without factoring in capital intensity and future growth rates turns cheap stocks into traps and makes expensive stocks look like unwarranted risks. To avoid these distortions, professional analysis prioritizes the long-term structural health of a business rather than any single year's results. This dashboard isolates specific red flags that invalidate a low multiple: isolated one-year spikes, massive working capital swings, and unusually low capital expenditure. The ultimate green flag looks like this. Over a multi-year horizon, free cash flow moves in tight parallel synchronization with operating profit. Identifying these patterns is the only reliable way to separate short-term accounting noise from genuine corporate earning power. The idea that cash flow is an unmanipulable metric compared to accounting profit is a myth. Simple timing differences, intentional delayed payments, and capital allocation choices all distort isolated cash metrics on a spreadsheet. In real investing, the goal is never to simply hunt for the lowest mathematical multiple. The actual goal is to look past the simple math and identify a reliable, durable, and repeatable stream of cash. Abandoning the surface mirage of cheap multiples to understand the deep mechanics of a business is the shift that separates average participants from exceptional investors.